Okay, well, welcome to the Baker Institute. We're happy to have everybody here, and especially happy to have Mark Finley here to present BP's Energy Outlook. The world is tumultuous, to say the least. A lot of things happening domestically, a lot of things happening abroad, sort of trying to filter through the political turmoil that seems to have erupted on the heels of, particularly in the energy space, some significant economic turmoil is not an easy thing to do, and hopefully Mark will shed a little bit of light on that for us today. Mark is General Manager at BP of Global Energy Markets and U.S. Economics. He's got a deep root in actually publishing the BP Statistical Review, which I know a lot of people, including myself, actually use quite a bit. It's a great source of historical data, and we were actually talking just before this, and he was commenting on the presentations that he's made there, and it's always sort of, so what's next? And this is what's next. What is the outlook? So what does the history tell us might actually come to pass as we move forward? Mark also has a tremendous amount of experience in Washington, D.C., both public and private sector, affiliations with the University of Michigan, with the International Association for Energy Economics, on and on and on and on. Very sort of decorated, if you will, past. But we're very fortunate to have him here today. He will make his remarks, and then we'll open the floor to questions. So if you could, unless it's a clarifying question, please refrain until the end of the comments. Okay, Mark, please.
Ken, thank you for the gracious introduction, and I can't remember being called decorated before, so that's a new one. I hope that doesn't mean I'm about to become retired or something, too. If you know something I don't tell me. I'd also like to thank all of you for taking time out of your busy schedules to join us for what I hope will become a discussion of energy issues. And to me, that's actually one of the attractions of doing that, especially here at the Baker Institute, because there's so much expertise on energy and geopolitics here. And let's face it, there are no facts about the future. And so as we put this outlook together, it's not built with the intention of saying, well, we know better than you, and here's the way the world's going to be. It's rather to say, we're going to slog through all of the issues as best we can, changes in the world's economy and technology and public policy, and force ourselves to make hard decisions about what we think is most likely to happen. Not because we think it's actually most likely to happen, but as a basis for conversation. In the process of putting that outlook together, we reveal what are some of the key issues that we want to dig deeper into, and what are some of the key uncertainties that could put the world's energy system on different paths. And that's really the conversation about those issues and uncertainties is really, I hope, the value added. And so I am going to share with you our reference case, the case that we think is most likely based on how we see the world's economy, technology, and policy evolving over the next 20 years. But as we get into it, we'll also start to dig deeply into certain issues that will be of a special consequence, or certain observations that come out of this, and also some key uncertainties of different pathways the energy system might take. And hopefully we can do all that in about 40 minutes and still leave time for question and discussion. And I would be remiss if I didn't also begin by not only thanking Ken and the folks here at the Baker Institute, but welcoming the students and faculty here. I mean, I'm especially excited to have a chance to interact with you all, and wishing you well in your studies and research. So what I'm going to do is begin with a presentation of a high-level overview of some of the conclusions that come out of our reference case. Then move into a discussion of oil and gas in more detail. As we do that, we'll start to get into these key issues and key uncertainties. And then we'll all end with some discussion about CO2 emissions and climate as well. I should mention, the more detailed reference document of the BP Energy Outlook is available on our website. At the website, you can find the full Energy Outlook, an Excel spreadsheet with a lot of the supporting data, as well as videos, country fact sheets, etc. So a lot more resource there, if this whets your appetite to learn more. So first, some of the key high-level summary judgments that come out of our review of the reference case. We, like almost everybody else, believe that global energy demand will continue to grow, and that growth will be driven by rapidly growing emerging economies, especially in Asia, as billions of people are lifted out of poverty and achieve middle-class incomes and status. Within that growth of energy demand, we believe that over time, the shares of fuels will evolve in the direction that the average carbon content of the world's energy mix will begin to decline, as coal in particular loses market share to renewable energy as well as natural gas. And then finally, in the background, what is driving a lot of this growth is electrification. And again, we'll revisit each of these themes as we go through the data. But first, we don't consume energy for the fun of it most of the time. We consume it to produce economic activity. So a good starting point when you're talking about prospects for the energy demand is to say, well, what are your prospects for the world's economy? And that's what I'm showing you here. I'm actually showing you the same picture twice, sliced different ways for perspective. And what I'm showing you is average growth in the world's economy, from the 1970s to the 1990s for the most recent 20 years, and then for our forecast. And you can see that average world economic growth is roughly what it was in the last 20 years. What drives that? Well, there's a bit of growing world population, but that's really not the motor of growth in the world's economy. Rather, it's what we call here productivity. It's especially poorer countries adopting the capital and best practices that we already enjoy and take for granted in the more industrialized economies of the world. So, obviously the capital stock continues to improve in the mature economies as well, but the real driver is income growth and, in the emerging economies. And in fact, that's demonstrated on the right-hand side where you see that India and China by themselves account for half of all of the growth of the world's economy in the next 20 years. Now, this is annualized. If you roll that and compound it over 20 years, essentially what it means is that the world's economy doubles by 2035. And as the world's economy doubles, demand for energy grows. It grows by 30% in our outlook. On the left-hand panel, I'm showing you where the growth takes place. Demand for energy here in the United States and in the other mature economies of the Organization for Economic Cooperation and Development is essentially flat. That is to say, all of the net growth in global energy demand in our forecast comes from emerging economies. Now on the right-hand side, I'm showing you again average growth over time, and again, the growth in the world's economy is roughly stable. But the growth of energy demand, even as it grows by 30%, slows significantly. In other words, it must be the case that the world's economy is getting more efficient over time, and that's what I'm showing you on the green bar here. We call it energy intensity. It's a measure of the amount of energy needed to produce a dollar or a euro or a yen of economic activity around the world. Tends to be a negative number over time, and I'm sure many of you recognize that from your own business experience, the constant pressure to do more with less. So it's embedded in the world's economic system that it becomes more efficient in the way it uses energy. We project, however, that rate of improvement will accelerate over time. And that's due in large part to two key factors. Factor number one is an evolution of China's mode of economic development. China is in the process of switching from, at a high level, stereotyping from energy-intensive export-led economic growth to more of a focus on domestic consumption of goods and services, which is less energy-intensive. The other factor, and I always look up is to see if there's LED or compact fluorescent light bulbs in the room where I'm speaking. It's just a growing focus on using energy more efficiently and among businesses and policymakers. And so those two factors of China's evolution and a growing focus on using energy more efficiently drive this improvement of energy intensity, the result of which is that the growth rate of energy demand slows even as the economy stays stable. I'm showing you the same picture on the left, again, sliced a different way for perspective. Here I'm showing you the growth of energy demand by fuel. And the real point of it is the right-hand panel, which is showing you market shares. So today, oil is and remains over the course of our outlook the leading fuel in the world by market share, but has generally been losing market share over time. Coal was the big winner in the market share battle for energy in the last decade, again, more 20 years, on the back of China's breakout economic development. In our outlook, the big winners by market share are renewable forms of energy, which triple their global market share, reaching about 10% of the global energy mix by 2035, as well as natural gas continuing its long-term trajectory of gaining market share. And as you can see, natural gas is the only fossil fuel that gains global market share. The impact of these changes in the beginnings of a transformation in the world's energy system are that today, fossil fuels account for 86% of the world's primary energy consumption. By 2035, that falls to 75%. So we're still a world with a significant role for fossil fuels, but that share is diminishing over time, largely due to the rapid growth of renewable energy. I mentioned already a couple of themes that I want to pause on. First is China's economic transformation and what it means for energy. On the left-hand panel, I'm showing you growth of coal consumption around the world in history and in our forecast. You can see that China dominated the growth of coal consumption in the world in the last 20 years. In fact, China today consumes half of all the coal on the planet, and that's a degree of domination that no country has for any other fuel that we track. But that's already changing, due to a combination of factors, including the slowing of China's economic growth, the reorientation of economic activity, which I mentioned earlier, and a deliberate policy to diversify the domestic fuel mix in China, which we see on the right-hand side. Today, about 2/3 of all the energy consumed in China is coal. In our outlook, coal consumption growth slows dramatically and, in fact, begins to decline in China in the later years of our forecast. But China has the biggest growth of energy demand of any country in our outlook still. And on a fuel-by-fuel basis, China has the biggest growth of demand for oil, natural gas, nuclear energy, hydroelectricity, and renewable energy. And the result is that market share for coal falls significantly to about 45%, in fact less than 45% in China's energy mix by 2035. By the way, the weakness of coal is not only a factor of China. You also see that coal consumption has been falling and is projected to continue to decline in our reference case in the US and in the other mature economies of the OECD, driven by a combination of environmental policy aimed specifically at reducing the importance of coal in power generation, as well as here in North America, cheap shale gas, combined with, in all those cases, increasingly competitive renewable energy. This chart shows you on the left-hand side the share of renewables in total power generation, and Europe continues to lead the way, but Europe's really not where the action is in terms of growth increments, and you can see on the right-hand panel that China actually replaces both the EU and the US to become the biggest source of growth of renewable energy in power generation in the world. And here it's primarily wind and solar, by the way. And this rapid growth is driven by a combination of continued government support, but also improved economics. Costs for wind and solar are falling rapidly as these technologies scale up, and we believe that there's significant scope for them to continue to improve their cost competitiveness in the future. And the results are the rapid growth in absolute terms and in terms of market share that I've shown here. Final point on the energy overview is the growing importance of power generation. So in our outlook, power alone accounts for 2/3 of all of the growth in the world's consumption of energy between now and 2035. On the left-hand side, I'm showing you the share of all of the world's energy consumption that is used to generate electricity. And I'm sure you recognize this dynamic from your own life. There's always one more gadget you have to plug in, right? But the real goal, the real prize here is electrification in emerging economies. And you can see in particular the role of China, and the importance of electrification in China's energy mix as a driver of this. By the way, in our energy outlook this year, we also have a section that introduces some themes looking beyond 2035. And one of the themes that we look at is the prospects for electrification over the longer term future. And it's not hard to build scenarios where just electrification could, in the distant future, easily account for 100% of the world's net growth of energy demand, over longer time periods. Let me move now from a discussion of the broader energy mix into a discussion of oil and gas. I'll begin with oil. And with oil, I want to pose and dig into two questions, one on the demand side and one on the supply side. So I don't know what the conversation is like here at Rice University, but as I travel, electric cars comes up everywhere. And so we thought, all right, well, let's have a look. First, a bit of context. I'm showing you here our projections in our reference case for global oil demand. I should say, by the way, liquids demand, because we include in our liquid analysis framework biofuels and small amounts of gas and coal to liquids as well. You'll also notice that we have changed units. Now we're back to millions of barrels a day, which is the convention when you talk about the oil market. We believe that global oil demand will continue to grow. In fact, in aggregate, it'll grow from about 95 million barrels a day today to about 110 million barrels a day by 2035. And I'm showing you on the left-hand panel where that growth comes from on a sectoral basis. The transport sector accounts for about 2/3 of all of the growth in oil demand in our forecast. On the right-hand side, I'm showing you annual average growth rates. And you can see that while oil demand continues to grow, the rate of growth slows significantly in the later years of our forecast. And moreover, that the slowdown is almost exclusively due to slower growth of consumption in transportation. And I'll come back to that. The ramification of it for our outlook is that by the later years of our outlook, the biggest source of growth for oil demand is what we've called here non-combusted fuel. That is to say, oil that's used as a petrochemical feedstock or road construction, things like that. The hint is in the title. Non-combusted means that it doesn't contribute to CO2 emissions because it doesn't get burned. So in the future, in the longer end of our forecast, the growth of oil demand around the world does not contribute to CO2 emissions. Let me dig more into the transport side of it. Obviously, the platform by which oil is consumed in transport matters. And so I want to take a bit of time to discuss our views on the vehicle fleet. Here I'm showing you on the left-hand panel the projected growth in cars. And I'm singling out cars specifically, as I did on the previous chart, specifically because we want to look at this question of electrification. And our central view is the heavier the vehicle, the harder it is to electrify because the weight load, is a bigger drag on the battery. So we think it's more likely that cars get electrified. So let's start with looking at cars. We can talk about trucks and other transport as well if you're interested, but we project that the car fleet in the world will double. And moreover, that most of that growth will come from emerging economies. Oddly enough, as people get richer, they want cars. And so that's reflected in our outlook. I'm also showing you that by 2035, we're projecting that about 100 million of a global car fleet of 1.8 billion vehicles will be electric. That's a significant upward revision from last year's edition of the BP Energy Outlook. And the reason why we've revised it up is because we have revised our estimates of the cost of battery packs down, as the progress on improving this technology has been faster than we had previously expected. Now you'll notice on the right that this stylized representation of the competition between battery packs and internal combustion engines is not exactly a very precise chart. And that's on purpose. The honest answer is, who knows? Nobody really knows, at what point electric vehicles, will become competitive with internal combustion engine. It depends on a lot of factors. Price at the pump, price of electricity, the cost of a battery pack, the ability to improve the fuel efficiency of the internal combustion engine, government policy, consumer preference. If anyone can figure out how to model that, by the way, let me know, because that's the one that we continue to wrestle with. So a lot of uncertainties around this, and I'll come back to those uncertainties shortly. for the purposes of our reference case, the bottom line of our framework is shown here. So we start with the level of oil demand for cars in the world in 2015, which is the base year of our forecast. If you double the car fleet, you double the amount of oil consumed in transportation, roughly speaking. Maybe a bit more than double, because the average new car in emerging economies tends to get driven more miles than the average car in the world today. But that's all other things being equal, and other things are not equal. And in particular, the biggest thing in our reference case that's not equal is we see a tremendous improvement in the fuel efficiency of the average internal combustion engine car on the road. Today, the average car on the road gets 30 miles a gallon. Now, I know in Houston, the average personal vehicle probably doesn't get 30 miles a gallon. But remember, trucks are a separate part of and SUVs are not part of our analysis of cars. The average car in the world in our outlook gets 50 miles a gallon by 2035. And actually, that's largely driven by policies that are already on the books here in the US, in Europe, and even in places like China. So if we account for the dramatic improvements of fuel efficiency of the average car, you cancel out a lot of that prospective growth of oil demand. And then you can see we've also have a small role for natural gas in cars, a slightly bigger role, by the way, for gas in other forms of transport, and then electric vehicles. So here's the point. 100 million electric cars in 2035 reduces world oil demand by about 1 million barrels a day. So, what if we're wrong? Very easily could be the case. What if there's 200 million electric cars? What if there's 400 million electric cars? Unlikely to be a game changer, by itself. Over at least over the next 20 years, our view is that electrification of the vehicle fleet, even with much more aggressive assumptions than what we have in our reference case, is unlikely to be a game changer for transportation. But that's not the whole story, because it's not just electrification of transport, that we have to think about. There's a whole lot of other things going on in the mobility sector that we need to try to get our heads around. There's autonomy, which has the potential to make vehicles much more fuel efficient simply because they don't stomp on the gas and stomp on the brake like you and I do when you drive. What we call here car sharing, which is services like Uber or Zipcar, that allow the vehicle to be used by more people. And then, in the European context, ride pooling, what we here in the US would call carpooling, putting more people in the same car at the same time. So we've developed a framework that will allow us to think through all of these different factors, and that we've actually included in this year's edition of the Outlook a technical appendix that invites you to build your own assumptions. So if you don't agree with the numbers that I'm going to show and put up, you feel free to, we've given you tools that will allow you to build your own scenarios. For the purposes of discussion, we've built kind of two scenarios that, try to bookend some of these concepts. So on the left-hand side, we're looking at a digital revolution. That is to say, we're running out a scenario that lets the software change, but not the hardware. So essentially what it means is, don't worry about battery cars. That's the hardware part. Let's just worry about the digital innovation. What if we see 200 million additional autonomous vehicles? Because we think they operate more efficiently, they can reduce demand a bit. If all of those autonomous vehicles are also used for Uber, and car sharing services, meaning they get driven more miles, then you can essentially double the impact. If you assume that those cars get driven twice as many miles, you multiply the fuel efficiency gains. If we also think that there are carpooling services that will reduce the total number of miles driven by 5% in the world, then you can see that, we could reduce oil demand by 2035 by a couple million barrels a day, but all those digital innovations make it easier to consume transportation. So anybody here who's taken an econ class can answer this question, and I'm guessing that anybody who hasn't taken an econ class can answer this question. If you make it easier to consume transportation, what do you think happens to the demand for transportation? Of course. So the answer is, we actually don't know what the impact of digital innovation is for oil demand, because it could very easily be the case that the demand elasticity for consuming transportation completely offsets all the efficiency gains. So the honest answer is, nobody knows. It's indeterminate. But if we take that digital innovation and we pair it with electrification, so all of those autonomous, Uber, carpooling, technologies that I mentioned in the first case all take place in the platform of electric vehicles, well, then you can very quickly get into a scenario where you do see a material impact on oil demand and transportation over the next 20 years. So again, as we've noodled through the numbers, it's hard for us to come up with a scenario for electrification that by itself is a game changer for oil demand. But if we pair electrification with digital innovation, you could very easily get into material implications for oil demand. So that's the demand side. The next thing I wanted to do is think about the supply side. And in particular, I've posed the question here about what is the growing awareness and realization that resources are abundant mean for strategic thinking among key low-cost producers. So let me elaborate on what I mean. On the left-hand side, I'm showing you estimates of technically recoverable resources around the world. So this is hydrocarbon resources, oil resources in this case, that can be developed using current industry technologies, but without regard to the economics of it. This is an enormously huge number, 2.7 trillion, again on to 2.6, 2.7 trillion barrels of technically recoverable resources. If we take all the prospective oil demand in our outlook over the next 20 years, heck, make it even all the way out to 2050 with some reasonable scenarios about the continued progression of oil demand, all of the oil that gets consumed over the next 35 years doesn't get you halfway to the current resource endowment. Now, there has long been a school of thought in the world's oil industry that these are finite resources. They don't make them anymore, and after you produce them, they're done. And at some point, you're going to run out. And so there have been periodic concerns in the history of our industry about whether oil production will peak and when do we run out of oil. That framework has colored the thinking of some of the key producers in the world. I've only been doing this for 30 years, but I can remember lots of oil decision makers, especially in the Middle East, saying we have 100 years worth of resource. We need to leave some in the ground so our kids and our grandkids can enjoy the wealth and the resource as well. But that's premised on the idea that everybody else is going to run out, and that after when your kids and grandkids get around to producing it, they're going to be holding all the cards because they're the only ones left. If you think that the world's not going to run out of supply, but you can envision scenarios where the world might start to run out of demand, our question is, how does that change your strategic thinking if you're a holder of a large resource? Obviously, if you think that there might not be demand in the future, you have more of an incentive to monetize that resource now. So we've taken a baby step in that direction by building into this year's edition of our Outlook an assumption that the holders of these large, low-cost resources, for the purposes of narrative, we've assumed that to be Middle East OPEC, Russia, and the best U.S. shale resources, assert their competitive advantage to grow market share. Now, obviously, this strategic decision has significant implications for future oil prices, for the competitiveness of alternative sources of high-cost supply. Now, again, lots of uncertainties around this framework. Can these holders of resource marshal the capacity, both physical and financial, to increase production? Can they live with the financial ramifications of these strategies, especially for countries that are heavily dependent on oil revenues? And by the way, what does the competition do? I see a lot of high-cost producers around the world frantically scrambling to reform both the business proposition and the government policy regime to try to stay competitive in the face of this. Again, early days, but we wanted to at least table that thought for conversation. Let me move next to natural gas. I've mentioned already that natural gas is the only fossil fuel that gains global market share. Here's the data. On the left hand is supply, driven by shale. What else? With the U.S., but eventually with material contributions from China and elsewhere around the world. On the right-hand side, I'm showing you the demand profile. The growth of demand for natural gas in our outlook goes into industry and especially into power generation. On a regional basis, I mentioned already, China has the biggest growth of natural gas demand in the world in our outlook. We also see significant growth increments coming out of the Middle East and here in North America, taking advantage of cheap domestic gas in particular. One dynamic that we're watching with great interest is the rapid growth of international trade of liquefied natural gas. And I'm showing you the supply on the left and the demand on the right. So in our outlook, liquefied natural gas trade more than doubles by 2035. In fact, LNG surpasses pipeline trade to become the single largest vehicle, if you will, for trading gas around the world. The big growth centers on the supply side are the US and Australia. On the demand side, it's an Asia story. The reason why this is important is because of the flexibility that it provides. You know, a pipeline goes from me to you, and if gas prices are high over there, there's nothing you can really do about it. You know, but an LNG tanker can pull out of the port and turn left or right depending on where the financial signals send it. So we think that this growing use of liquefied natural gas will help the world's gas system to become more connected. You know, we'll expect to see arbitrage providing linkages of regional prices, you know, increasingly over time. You could also make a very plausible case that this greater flexibility would mean a move potentially away from oil-indexed contracts which dominate LNG trade today and more toward hub-based pricing. And if that's the case, the question is, well, what's the hub? And the answer won't surprise people here. Here I'm showing you our LNG balance for 2035. So we see big growth of demand in Asia. We see big growth of supply in Australia, but it all stays in Asia because that's where the demand is. Meanwhile, we see big growth of exports of LNG in North America, and North America in effect becomes, you know, the balancing center for global LNG trade. You know, U.S. cargoes and North American cargoes more broadly will go to Europe, they'll go to South America, they'll also go to Asia. So guess what? If the question is, you know, where is the marginal supplier, you know, and therefore what is the hub-based pricing that will, you know, increasingly dominate international trade of liquefied natural gas, the answer is, we think, a plausible case to be made for North American hub-based pricing to be, you know, the big driver here. Let me move next to a discussion of carbon emissions, and I want to qualify this. I'm talking about CO2 from the combustion of fossil fuels, you know, not from other sources of CO2 and not other greenhouse gases. And what I'm going to show you as good news, there's bad news, and of course there's lots of uncertainty. So, would you expect anything else? So first, the good news. We project that the growth of CO2 emissions in the next 20 years will slow dramatically. In fact, it slows by 2/3 compared to the average growth of CO2 we've seen in the past 20 years. And the big drivers of that slowdown are that we use energy more efficiently and that the carbon content of the energy mix changes. Remember, natural gas and renewables are gaining market share at the expense of coal. So the low carbon sources of energy are gaining market share from the high carbon sources of energy. That's the good news. The bad news is that's still bigger than zero. CO2 emissions in our reference case grow by about 13%. For reference, the red line is a case produced by the International Energy Agency in Paris that says, well, what might be a representative trajectory for global CO2 emissions from energy in a world that is consistent with eventually limiting the accumulation of CO2 in the atmosphere to 450 parts per million, which is roughly equivalent to limiting, you know, as the climate scientists say, to limit the warming of the world to about 2 degrees C. So that would require a reduction from current levels of about 30% by 2035. So we've built a couple of different scenarios to begin to think through the ramifications for the energy system. First is a framework we rolled out actually last year. We call it a faster transition to a low carbon world. This is a world that assumes for, you know, more rapid uptake of technology and more aggressive climate policies than we have built into our reference case. So for example, I've mentioned already in our reference case we have 100 million electric vehicles. In this case we have 200 million. In our reference case we have climate policies progressing to eventually a point in the richer countries of the world where the carbon policies deliver something equivalent to a carbon price of about $40 a ton. Here it's $100 a ton. In that case, we can envision a world where CO2 emissions peak in the next decade and begin to decline, but they only decline by about 10%, not 30%. So, we've developed another case which we're calling, very creatively, the even faster transition. And big caveats around this. I mean, this is stretching to the limit our ability to model the world's energy system, because these are such big changes and so different from the way the world works already. So, so again, in our reference case, 100 million electric cars. In the faster transition, 200 million. In the even faster transition, 400 million. Essentially, everything is doubled. So instead of a carbon price of $100 a ton, here's a carbon price of $200 a ton. Now, as the way we've built this, what it means is that the most aggressive transformation takes place in the power sector. To us, that looks like where the lowest hanging fruit is. This results in deep decarbonization of the world's power generation. In fact, in the even faster case, CO2 emissions from the world's power sector are about 25% of what they are today. So massive decarbonization in the power sector. And what that means for energy is shown here. On the left-hand side, I'm showing you average annual growth in the world's energy demand in the last 20 years, in our base case, and then in these two alternative climate transition cases. A couple of things to point out. Energy demand grows in every case, even in the most aggressive climate transition that we can imagine. But in both of the climate transition cases, all of the net growth comes from non-fossil forms of energy. Coal is the big loser. But even in the most aggressive climate transition case that we can imagine, consumption of oil and gas in the world in 2035 is roughly what it is today. And in fact, on the right-hand panel, I'm showing you again, even in the even faster transition, oil and gas combined are still about 50% of the world's energy mix. So even in a world of an aggressive transition to a lower carbon future, there's still a significant role for oil and gas to be played. I won't give you a quiz on this table, don't worry. The point of the table is to say, well, we've looked at aggressive transition cases, and so have other people. So we want to compare our outlook with other forecasters who have developed aggressive transition scenarios, roughly equivalent with a 2-degree climate scenario. And then we have different metrics of how the system changes for comparison's sake. And this is available in our main Outlook document. You can go through it at your leisure. I want to point out two things. Thing one, almost all the other forecasters project that oil and gas will continue to account for, in the ballpark of 50% of the world's energy mix, even in an aggressive transition scenario. On the other hand, there are significant differences in how you come at this. We tend to put more emphasis in our outlook on carbon intensity, that is to say, switching fuels within the fuel mix. More renewables and gas, less coal. Other forecasters tend to put more emphasis on getting efficiency out of the system. Does this mean that they're right and we're wrong, or the other way around? Come on, the answer is who knows. To me, the key point is serious people who have looked at this have come to some significantly different conclusions about what that transition looks like. And to me, what it means is, do we really want to put the burden on ourselves and our policymakers today of saying, you pick which is the best path? I think that that's too tall an order given the uncertainties. And so we at BP have long advocated for a market-oriented approach, put a price on carbon and let the market sort out which is the low-cost option, for transitioning the world's energy system. One final point, and that is the ramifications of policy assumptions for natural gas demand. I've mentioned several times already that gas is the only fossil fuel that gains market share in our mix, and here's our projected gas demand growth in our reference case. I have just shown you, however, that under the more aggressive transition scenarios that I have listed, natural gas demand gets reduced. The growth rate of natural gas demand slows. But remember, our reference case already includes assumptions about additional climate policies, including policies aimed at replacing coal with natural gas as well as renewables in power generation. But what if that doesn't happen? What if key countries around the world say, yeah, maybe we can live with coal? Whether it's because there's a loss of momentum around climate agenda, maybe there's more of a focus on domestic energy security and coal is domestically produced. The point being, we can envision an alternative world, shown by the dotted lines here, where coal does not lose market share as aggressively and gas does not gain market share in the global mix. In other words, gas demand can be put at risk with assumptions of less aggressive climate policy as well as more aggressive climate policy. Let me wrap up, and hopefully I've left some time for discussion and questions. Thanks for hanging in there. So we've reviewed kind of at a high level our reference case, what we think is a most likely pathway for the world's energy system. Out of a sense of humility, we lay it out there for the basis of conversation rather than to say it's what we really think, that we know better than anyone else. But in that reference case, world's energy consumption continues to grow. The growth rate is moderated by significant improvements in the efficiency of energy use. The growth is driven by emerging economies. Within that growth, the fuel mix shifts, less coal, relatively speaking, in percentage terms, more renewables, natural gas, so that the carbon content of the mix gradually eases. For oil, we looked at the drivers, pun intended, of oil demand growth and the key uncertainties and factors around that, especially with regard to a transformation of the mobility system and the range of possible outcomes that we can envision. We've also looked at how producers' strategic thinking might be changing in the face of this evolution of the oil space. For natural gas, we've looked at the drivers of supply and demand growth, the growing role of LNG, and the prospects that it holds to link markets together. We've looked at a couple of different trajectories for CO2 emissions as well. And again, there's a lot more resource available at the website that I would encourage you to look up. Hopefully we've whetted your appetite and left you wanting to learn more, not less, about this. With that, why don't I wrap up and we'll take some questions. Thank you again.